3 years ago, I made a decision that would change how I think about precious metals forever. My father had accumulated physical silver for over 2 decades. Coins, bars, rounds, stored in a safe in his basement. When his health declined and he needed funds for long-term care, he asked me to liquidate his position. I sold his physical silver, all of it. And what happened next taught me more about markets, timing, human psychology, and the true nature of wealth preservation than any textbook ever could. Today, I want to share that story with you. But more importantly, I want to share the lessons embedded within it, because whether you currently hold physical silver, are considering buying it, or simply want to understand how precious metals fit into a broader financial strategy, what I learned applies directly to your situation. This is not a video about getting rich. This is not a video about predicting the future. This is a video about understanding what you own, why you own it, and how to make rational decisions when the market and your emotions are pulling you in opposite directions. So let me take you back to the beginning. My father began buying silver in 1998. At the time, silver was trading around $5 per ounce. Most people thought he was eccentric. Precious metals were considered relics of a bygone era, remnants of a financial system that had evolved beyond them. But my father saw something different. He watched the national debt grow. He observed the expansion of credit. He questioned the sustainability of a monetary system that seemed to require perpetual growth to function. And so, month after month, year after year, he converted a portion of his savings into physical silver. By 2011, when silver briefly touched nearly $50 per ounce, his position had grown substantially in value. Friends and family who had mocked his obsession suddenly wanted to know his secret, but he didn't sell. He believed in the long-term thesis. He believed that the fundamental issues he had identified in 1998 had not been resolved, they had only been postponed. So he held. Then came the correction. Silver dropped to the low 30s, then the 20s, then into the teens. For years it languished. The mainstream financial media declared precious metals irrelevant. The narrative shifted entirely to equities, then to technology stocks, then to cryptocurrencies. My father kept holding. By the time I was managing his affairs, silver had recovered somewhat, but remained well below its previous highs. His original investment thesis remained intact in his mind, but his circumstances had changed. He needed liquidity. And so the decision fell to me. I contacted dealers. I compared premiums. I organized the logistics of transporting and selling several hundred ounces of physical silver. And within a few weeks, the position that had taken 20 years to build was converted back into dollars. I remember the exact day the transaction completed. I remember feeling uncertain. I remember wondering if I was making a mistake. What happened next is something I want to discuss carefully, not because the price movement was extraordinary, but because my reaction to it revealed something important about how we process financial decisions. In the months following the sale, silver's price increased. Not dramatically, not in a way that would make headlines, but enough to make me question myself. I found myself checking the spot price daily. I calculated what the position would have been worth if I had waited. I experienced what behavioral economists call regret aversion, a psychological state where the pain of a perceived mistake outweighs the actual financial impact. Here's the truth that took me time to accept. Whether the price went up or down after the sale was largely irrelevant to whether the decision itself was correct. Let me say that again because it is foundational to everything else I want to share today. The quality of a financial decision is not determined by its outcome. It is determined by the reasoning that informed it. My father needed liquidity. His circumstances required a change in strategy. The sale accomplished what it needed to accomplish. The fact that the price moved afterward was simply the market doing what markets do. This is the first major insight I want you to carry with you. We live in a culture that judges decisions by results. We celebrate investors who got lucky and criticize those who were unlucky, often without examining whether their reasoning was sound. But luck is not strategy. And short-term price movements are not validation. If you own physical silver or any asset, you must separate the quality of your reasoning from the randomness of market fluctuations. Otherwise, you will spend your entire investing life second-guessing yourself, chasing returns that already happened, and making emotional decisions based on outcomes you cannot control. Now, let me provide the broader context that every silver investor needs to understand. Because my father's story is not unique. Millions of people around the world hold physical silver, and most of them are operating with incomplete information. Silver occupies a unique position in the financial ecosystem. It is simultaneously a monetary metal with thousands of years of history, an industrial commodity with expanding applications, and a speculative asset subject to significant volatility. This dual nature creates complexity. Unlike gold, which is primarily monetary and ornamental, silver's industrial demand means its price responds to economic growth cycles, manufacturing trends, and technological innovation. Consider the sectors driving silver demand today. Solar panel manufacturing consumes increasing quantities of silver each year. Electric vehicles require silver for their electrical systems. Medical devices, water purification, electronics, and emerging technologies all depend on silver's unique properties. This industrial foundation provides a demand floor that pure monetary metals lack, but it also introduces vulnerability. During economic contractions, industrial demand can decrease sharply, placing downward pressure on prices even as investors seek safe haven assets. Understanding this tension is essential. When you buy physical silver, you are not buying a simple hedge against inflation or currency debasement. You are buying exposure to a complex commodity with multiple demand drivers, each operating on its own timeline. Silver is volatile. This is not speculation, it is historical fact. In the past 50 years, silver has experienced several dramatic cycles. The late 1970s saw silver rise from around $4 to nearly $50, driven by the Hunt brothers' attempted corner and broader inflation concerns. The subsequent crash brought prices back to single digits. The 2000s saw a gradual recovery, accelerating after the 2008 financial crisis as central banks implemented unprecedented monetary stimulus. Silver rose from around $9 in late 2008 to nearly $50 by early 2011, a gain of over 400% in less than 3 years. Then came the decline. Over the next decade, silver would trade as low as $14, frustrating investors who expected the post-crisis monetary policies to drive sustained precious metals appreciation. What can we learn from these cycles? First, silver is capable of rapid appreciation during periods of monetary stress, currency concerns, or speculative enthusiasm. Second, silver is equally capable of prolonged consolidation or decline, sometimes lasting many years. Third, the timing of these cycles is extremely difficult to predict, even for professionals with sophisticated models and extensive resources. This history should inform your expectations. If you hold physical silver, you must be prepared for extended periods where your investment appears to be underperforming other assets. If you are considering buying, you must understand that entry timing can significantly impact your experience, even if the long-term thesis proves correct. What drives silver's price over the long term? Understanding these forces helps you interpret market movements without reacting emotionally to every fluctuation. Monetary policy is perhaps the most significant factor. When central banks expand the money supply, purchase assets, or maintain interest rates below inflation, investors often seek hard assets as protection. Silver benefits from this dynamic, though not always immediately or proportionally. Real interest rates matter enormously. When the return on holding cash or bonds, adjusted for inflation, is negative, the opportunity cost of holding non-yielding assets like silver decreases. This tends to support precious metals prices. Conversely, when real rates rise, silver often faces headwinds. Currency dynamics influence silver as well. Since silver is primarily priced in dollars, movements in the dollar's exchange rate against other currencies affect demand from international buyers. A weaker dollar makes silver cheaper for foreign purchasers, potentially increasing demand. Investor sentiment and positioning can create short-term price swings that seem disconnected from fundamentals. Futures markets, exchange-traded products, and algorithmic trading can amplify movements in both directions. Finally, there's the physical market itself, the actual buying and selling of metal. Premiums over spot price, dealer inventory levels, and retail demand all provide signals about market conditions that paper markets may not fully capture. I want to be careful here. I'm not going to predict where silver will trade next month or next year. Anyone who claims certainty about future prices is either deceiving themselves or attempting to deceive you. What I can share are the conditions and signals that informed investors monitor. Watch central bank policy. Are they tightening or loosening? What is the trajectory and what are they communicating about future actions? Monitor real interest rates. Calculate the difference between nominal rates and inflation measures. When this number is deeply negative, conditions tend to favor precious metals. Observe the gold to silver ratio. This measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, this ratio has averaged somewhere between 40 and 60, though it has reached extremes of 20 on the low end and over 100 on the high end. Some investors use this ratio to assess relative value, though it should not be used in isolation. Pay attention to physical market conditions. Are dealers reporting strong demand? Are premiums elevated? Is there inventory available? These ground-level observations can provide insight that financial media often miss, and perhaps, most importantly, assess your own circumstances. Your investment horizon, liquidity needs, emotional tolerance for volatility, and overall financial position should drive your decisions more than any market forecast. If you currently own physical silver, this section is specifically for you. Before making any decision about your silver position, you must clarify your own reasoning. Why did you buy it? What thesis informed your purchase? Has that thesis changed? Some people buy silver as insurance against extreme scenarios. currency collapse, banking crises, or social disruption. If this describes you, then short-term price movements are largely irrelevant. Insurance is not evaluated by its daily market value. It is evaluated by whether it performs its protective function when needed. Others buy silver as a portfolio diversifier, seeking assets with low correlation to stocks and bonds. If this describes you, periodic rebalancing may make sense, selling some silver when it appreciates significantly relative to other holdings, buying more when it declines. Still, others buy silver as a speculation, hoping to profit from anticipated price increases. If this describes you, discipline becomes essential. Speculators who cannot admit when their thesis is wrong often give back their gains and more. Know which category you fall into, and if your circumstances have changed, as my father's did, be willing to adapt your strategy accordingly. Physical silver is not a liquid investment. Converting it back to cash requires time, effort, and transaction costs. Dealer spreads, shipping expenses, and potential tax implications all reduce your effective return. If you may need the funds within the next year or two, physical silver carries meaningful risk. A price decline during that window could force you to sell at an unfavorable moment, exactly the scenario that destroys investment returns across all asset classes. If your time horizon extends 5 years or more, short-term fluctuations matter less. You have the luxury of patience. Use it. This is where many precious metals investors make mistakes. In their conviction about the thesis, they allocate too heavily to silver. What percentage of your net worth is in physical silver? If the answer is more than 15 or 20%, you may be taking on unnecessary concentration risk. Diversification is not a sign of weak conviction. It is an acknowledgement that we cannot predict the future with certainty. Even if you are correct about the long-term direction, being overexposed to a single asset creates vulnerability. Consider whether a reduction in position size might actually strengthen your overall financial resilience, even if it means holding less of an asset you believe in. One of the most common failures among precious metals investors is the absence of a clear exit strategy. They know when and why they bought, but they have never defined the conditions under which they would sell. Ask yourself, what would need to happen for me to reduce or eliminate my silver position? Is there a price target, a change in fundamental conditions, a life circumstance? Without clarity on these questions, you risk holding indefinitely through peaks and troughs, never actually converting paper gains into realized wealth. I am not suggesting you need to sell at any particular point. I am suggesting you need to know what your decision criteria are before you need them. If you are considering purchasing physical silver, this section addresses your specific concerns. Why do you want to buy silver? Be honest with yourself. Is it because you have developed a well-reasoned thesis about monetary policy, currency dynamics, and portfolio construction? Or is it because you read an article, watched a video, or heard someone at a social gathering mention that silver is going to explode? The former is a legitimate foundation for investment. The latter is a recipe for disappointment. Take time to educate yourself. Understand the arguments for and against precious metals. Read primary sources, central bank communications, economic data, academic research, rather than relying solely on commentators who may have their own agendas. Conviction that comes from understanding is durable. Conviction that comes from persuasion is fragile. If you have decided to accumulate silver, consider spreading your purchases over time rather than making a single large buy. This approach, often called dollar cost averaging, reduces your exposure to timing risk. You will buy some ounces at higher prices and some at lower prices. Over time, your average cost will reflect the market's range rather than a single point. This strategy is particularly valuable for an asset as volatile as silver. It removes the psychological pressure of trying to identify the perfect entry point, which does not exist except in hindsight. Set a regular schedule, perhaps monthly, and purchase a consistent dollar amount. Let the market give you more ounces when prices are low and fewer when prices are high. This mechanical approach bypasses emotional decision-making. Physical silver carries costs that paper investments do not. Premiums over spot price, dealer markups, shipping, insurance, secure storage, and eventual transaction costs when selling all reduce your effective return. If you buy silver at a 10% premium and sell it at a 5% discount to spot, you need silver's price to appreciate at least 15% just to break even before considering any other expenses. This is not a criticism of physical silver. There are legitimate reasons to prefer it over paper alternatives, including counterparty concerns and the tangibility of actual metal ownership. But you must understand these costs when evaluating your potential returns. If you are new to precious metals, resist the temptation to allocate heavily from the beginning. Start with a position size that allows you to experience silver's volatility without threatening your financial stability. Watch how the price moves. Observe your own emotional reactions. Notice whether you check the price obsessively or remain calm. This self-knowledge is valuable. It will inform how much exposure you can realistically tolerate over the long term. Many investors overestimate their volatility tolerance until they experience actual losses. Better to learn this lesson with a small position than a large one. The question of whether to hold physical silver or paper alternatives, exchange-traded products, futures, mining shares, deserves consideration. Physical silver offers direct ownership with no counterparty risk. You hold the metal. It cannot default, be rehypothecated, or disappear due to exchange failure. For those concerned about extreme scenarios, this attribute is valuable. Paper alternatives offer convenience, liquidity, and lower transaction costs. They can be bought and sold instantly, held in brokerage accounts, and used for tactical trading. But they carry risks that physical metal does not, including counterparty exposure and potential disconnection from actual metal prices during market stress. Many investors find that some combination makes sense. Physical for core long-term holdings, paper for more active strategies. There's no single correct answer. The right choice depends on your specific objectives and concerns. I want to be direct in this section. These are the behaviors that destroy wealth and generate regret. If you see yourself in any of these patterns, take immediate corrective action. Buying because prices are rising and you fear missing out. Selling because prices are falling and you fear further losses. This is the opposite of rational investing, yet it describes the behavior of most retail participants. Emotions are information, not instructions. When you feel urgency, fear, or excitement, pause. Examine whether the feeling is based on changed fundamentals or simply price movement. Almost always, it is the latter. Successful investors make decisions in calm moments and execute them mechanically, regardless of how they feel at the moment of action. Develop this discipline or accept that you will underperform. Borrowing money to buy silver or any speculative asset magnifies both gains and losses. Given silver's volatility, leverage can be catastrophic. A 30% decline in silver's price is not unusual. If you are leveraged 2 to 1, that becomes a 60% decline in your equity. If you are leveraged further, you risk total wipeout. Physical silver should be purchased with funds you can afford to hold for years, potentially decades. If you are borrowing to buy, you're speculating beyond your means. Stop. The financial media is filled with predictions. Silver will reach $100. Silver will collapse to $10. These confident forecasts attract attention precisely because they promise certainty in an uncertain world. They are noise. No one knows where silver will trade next year. No one knows when the next bull market will begin or the next correction will end. Anyone claiming otherwise is either uninformed or dishonest. Base your decisions on principles and processes, not predictions. Have a thesis. Understand the conditions that would validate or invalidate it, but abandon the search for someone who can tell you what will happen next. They do not exist. Every dollar in silver is a dollar, not in something else. This is obvious, but frequently ignored. While holding silver for 10 years, what else could that capital have achieved? What income could it have generated? What other opportunities were missed? I am not arguing that silver is a poor investment. I am arguing that every investment must be evaluated not in isolation, but relative to alternatives. If your conviction in silver causes you to ignore other potentially superior opportunities, you are making an implicit bet that silver will outperform. Make sure you are making that bet consciously. This bears repeating. Too many precious metals, investors concentrate excessively. I have seen portfolios that are 70, 80, even 90% in physical silver. When asked why, the investors cite conviction in their thesis. But conviction is not insurance against being wrong. And being wrong with a concentrated portfolio is painful in ways that diversified investors rarely experience. Spread your risk. Even if silver performs exactly as you hope, a diversified approach protects against the possibility that your timing is poor, your thesis takes longer to play out than expected, or unforeseen developments alter the landscape. When silver's price rises, it feels validating. When it falls, it feels discouraging. But price and value are not identical. If the fundamental case for silver remains intact, a price decline might actually represent an opportunity to acquire more ounces at favorable prices. If the fundamental case has deteriorated, a price increase might represent a chance to exit before others recognize the change. Think independently. Evaluate constantly. Do not let price charts substitute for analysis. In many jurisdictions, physical silver is taxed as a collectible, potentially at higher rates than other investments. Sales may trigger capital gains taxes regardless of whether you reinvest the proceeds. Before making significant transactions, understand the tax consequences. Consult with a qualified professional if necessary. Failing to account for taxes can substantially reduce your actual returns. Before concluding, I want to zoom out and share several principles that extend beyond silver to your entire financial life. The wisest investors I know do not try to predict the future. Instead, they prepare for multiple possible futures. They ask, what if inflation accelerates? What if we enter deflation? What if markets crash? What if they boom? What if my income is disrupted? A robust financial position performs adequately across many scenarios, not optimally in one specific scenario. This requires balance, diversification, liquidity, and flexibility. Silver can be part of such a position, but it cannot be the entire position. No single asset can be. Unexpected expenses arise, opportunities appear, circumstances change. Having readily accessible funds, cash, money market instruments, short-term bonds, provides options. Without liquidity, you may be forced to sell long-term investments at inopportune moments, exactly as my father's situation required. Before maximizing returns, ensure survival. Keep reserves sufficient to handle disruptions without disrupting your investment strategy. Physical silver is straightforward. You buy metal, you store it, eventually you sell it. The complexity is limited. Other approaches, options, futures, leverage products, exotic structured investments, introduce complexity that most retail investors do not fully understand. When these instruments behave unexpectedly during market stress, confusion can lead to catastrophic decisions. Stick with what you understand. There's nothing impressive about sophisticated strategies that you cannot explain clearly to another person. Simplicity is underrated. Set regular intervals, perhaps quarterly or annually, to review your financial position. Assess whether your circumstances have changed. Evaluate whether your investment thesis remains valid. Consider whether your allocation still reflects your objectives. Markets change. Your life changes. Your strategy should evolve accordingly. Rigidity is not conviction, it is stubbornness. When you consume financial content, including this video, ask yourself whether you are genuinely seeking to learn or merely looking for someone to confirm what you already believe. The most valuable information often challenges your existing views. It forces you to reconsider, to strengthen your arguments, or to change your mind. Content that simply tells you what you want to hear may feel good, but rarely makes you wiser. Be suspicious of sources that never question their own positions. Be suspicious of yourself when you seek only agreement.